Hi, welcome back to Common Sense Conversations. I'm Matt Rust, and you might notice that I haven't got my sidekick Eric with me today. Eric's spending some much needed time with his family. I did, however, bring my mathematician back onto the show. This is Jaron Love. Say hi.
Hello.
We didn't quite get as far as we wanted in the last episode, partly because I was just baffled at what was going to happen with some of these numbers over time. So we invited Jaron back to continue to pick up where we left off. We're just going to do a quick recap. We spent some time last episode explaining how qualified plans work. You'll recognize the pie chart we're going to show you, which you named, what did you call that, this display?
Where'd my pie go?
Where'd my pie go? That's right. We show this to people, and that's kind of what they ask. Wait a second, I thought I had more money than that. And you do. Everybody I talk to, they tell me about the balance in their 401k. And then I ask them, how much of that is yours? And they sometimes they look at me and they say, what do you mean how much of it is mine? All of it is mine. Well, not exactly. There's a whole lot of money in that pie that we see, but we know it's not ours. One of my mentors famously says we are delaying taxes into the future. Deferred taxation is great. Pushing that out as far as we possibly can is great. The problem with it is, along with deferred taxes, we're also deferring the tax calculation. So to get into this chart as a recap, I think, what did we have here for the tax rate in the future, Jaron?
We had a 25% tax rate for this calculation. We last episode we talked about, we changed these numbers quite a bit when we realized what would happen with inflation. But we've got this light green section here is the amount of money you contributed over your lifetime, assuming that you kept increasing your contribution 3% a year, assuming your employer's matching 25% of it that whole time. This is how much you're putting in. This is your portion of the pie.
Okay.
These earnings are everything your employer contributed, everything that you earned, assuming an 8% rate of return.
Okay. So we have an 8% rate of return every year for how many years? 40?
So I've got it from 65 to 25, so it's 40 years.
Okay. 40 years, 8% rate of return, employer matching our contribution up to 50% of our contribution. We are contributing $5,000. That means the employer is contributing $2,500, right, each year?
Well, this is at a 25% contribution.
Oh, 25%, thank you.
$1,250.
Okay. And then we are increasing our contribution by 3% per year, which also means that their contribution is going up by 3% per year, right?
Correct.
Okay. So a total of $361,000 contributed, total of $447,000 earned on those contributions. And all the rest of those pieces of that pie, the yellow, the red, the white, that's money that either was not earned along the way, paid out in fees to management, or taken out in taxes at the rate of 25% in the future once we start withdrawing that money. Is that correct?
Correct.
Okay. If you guys have any questions, concerns, complaints about this, please send us a message. We'll respond to those happily. We can certainly discuss all of these different numbers. There are quite a few people who feel like tax rates could be higher than 25% in the future on these withdrawals. Some people might want us to change the management fees or the contributions or the rate of return. I don't know very many people who realistically think that they're going to get 8% every single year and not have some declines or something in there. So we can make some adjustments to try to make it more realistic for you if you'd like to see something else. But this certainly paints a picture for us. Now, one of the consequences of these plans, and if you have one of these, by the way, I'm going to say my hat's off to you because at least you're saving money. You're contributing $5,000 a year, and you're receiving something from the employer as well. So the contributions are certainly there, and a lot of people aren't saving $5,000 a year. So if you're doing that much, really give yourself a pat on the back. One of the consequences, though, that we don't think about, and we certainly don't see it in this display right here, it's the fact that we can't go in and get a hold of that money just for anything that we want means that oftentimes a lot of Americans are going to the banks. They're borrowing money because they can't get at their own money to go and buy a car, for example. So I think last time we commented on how many more questions were asked on social media about how to get money out of a 401k type of plan in order to pay something like a rent or a house payment, right? And at one point, Congress passed legislation to make it easier for Americans to get money out of their qualified plans. But and good for them for doing that. It just proved, though, that it took an act of Congress literally in order for Americans to get money that we feel like it's our money, but it's tough to get to sometimes. So anyway, moving on, let's go to this next display that you have. We call this maximum earning potential because we want to show how much money a person is earning over their lifetime if they were able to save all of their money. Jaren's going to break this down. I'm going to give us big picture. If we're able to save every dollar we make because somebody else is paying our bills, let's just show how much we could have in our pocket at a certain point in the future if we could save every dollar and save it someplace where it's earning interest. Someplace with interest, without taxes, nothing coming out of it, we see the maximum. And then we start to plug in the realities, right? We plug in these different expenses and see how it chews away at that maximum potential, because our goal here is to help people keep more of the money they make. And part of the way we do that is by paying less in interest, by paying less in taxes, legally, doing everything we can to keep more of the money we make. So we start with the big picture of how much money a person is going to make, and then how much of that is going to be lost, which helps us understand how much we can recapture. Is that right?
Right.
Okay, well, here we go.
So I'm going to start with an accumulation period of 30 years. Basically, this means that maybe this person started out at 25 and they kept saving money till they're 65 or 55, or they started at 35 and they're keeping it till 65.
Okay.
With a 30-year accumulation, and it's 60,000.
And all of these can be changed, right?
Yes, yes, everything here can be changed.
Okay, very good.
And it's a $60,000 annual income. So over their life, over this 30-year time period, they're going to earn $1,800,000.
Okay, that's just 60,000 times the 30 years?
Yeah.
Okay.
And that big old pie, that's money that's going through this person's hands at $60,000 a year.
Okay.
Now, everybody would like to get a raise.
For sure.
Everybody, and so, and to a certain extent, people expect a raise. They expect their income to grow with time. Yeah. So we're going to increase this by 3%. And so now they're earning almost $3 million just by increasing their income 3% year over year.
It was 1.8 prior to that raise, right?
Yes.
So an extra $1 million because they increased their wages, their income somehow by 3% per year.
Correct.
Magic of compounding, right? That's why he's the mathematician.
So let's just pretend for a minute that this person was able to save all of this money. If they could save all of it and get an earnings rate of...
Saving it someplace like a CD, someplace where it's going to earn interest.
Yeah.
Got it.
Save 4%. Now, in addition to their $2.8 million, they've got a $2.2 million that's compounded over the last 30 years. So now you've got a total of, what, $5 million roughly? Oh, I guess we've got the total savings with interest here. But let's be honest, nobody can save all of their income.
I'm wondering, though, I want to see if we ought to make some changes. If for no other reason, I'm curious. I like what I'm seeing.
Okay.
And I'm wondering how realistic the 3% is, or how realistic it is that somebody will earn more than that. There was an interesting article I read in the not too distant past that had kind of analyzed people's career paths over their lifetime, their working years, and noted that most college graduates would not just change positions within their career, but actually change careers. I don't remember if it was 3 times in their lifetime or over their lifetime, maybe 5 times they were changing careers. And a large reason why we all change careers is because we see potential to earn more somewhere else. And I just don't remember exactly what the article said, but are you good enough at the numbers that you could give me an idea of how much that person is earning if they start at 60 and then get 3% more per year, what their income looks like 10 years down the road?
So what their income looks like 10 years down the road?
Mm-hmm.
I don't have that on this screen. Let me look at
If I just ran a
Can I pull the calculator
compound
out?
calculation on my phone or on this, would it just simply be a compound, 60 compounded at 3%?
Yeah.
Simple.
Well, it's compound interest essentially because you want a 3% raise this year.
Yeah.
Now you're getting an
sure.
extra
So it's
$1,800,
compounded,
but
yeah.
then
If you can
you
do
want
it
a
quickly
3%
there.
raise next year.
Mhm.
All I'm going to do is I'm going to pull up the calculations behind this sheet. So
Okay.
if we look at that, 10 years down the road, their income is $78,000.
Okay, so now I'm thinking, in my gut, does that feel right? And I think it probably does. I think that a person who's working for something like that could realistically be earning $78,000 10 years
After
after
10
they
years.
start a career. Same career, switch a career, but with experience, education, assuming they continue attending trainings or reading up or getting additional licenses or certifications or something like that.
Well, and as a young person
Sure.
earning money, like if I was earning $60,000 a year, and I have friends who are earning $60,000 a year, 10 years down the road, I would certainly want to be earning $78,000, $80,000 a year or more.
That's a good point, because that just barely keeps up with inflation. So
Right.
it doesn't really feel like an increase, even though the numbers are bigger.
Well, and that's true. Yeah, it absolutely may not feel
So do
like
me
an
a favor,
increase.
change the annual increase to 4% instead of 3.
Okay.
Well, an extra 800,000 over their life. See, this is why I bring him in, because I don't have a natural instinct for what these numbers are going to do over time. Need those calculations. Well, whether it's 3% or 4%, the big picture maybe doesn't matter much. Let's go ahead and continue with the calculator. Move it back to 3, just so that we can get
Okay.
back where we were, and continue with that.
So,
Thanks, Jaron.
obviously you don't get to save all your money. So we have to take this and we have to contribute taxes. Now there's a lot of different kinds of taxes. In this case, we're not just going to be talking about income taxes. That's what everybody thinks about, but you're paying Social Security, you're paying Medicaid or Medicare taxes. If you buy a house, you're going to have property taxes. You're going to pay sales tax on everything you buy unless you own a business. So let's say,
You know, I saw a list a couple years ago at a conference or something, and somebody had identified all the taxes, federal and state, the various taxes that we might pay, and even things such as registrations on our cars. One person jokingly talked about their dog tax because they have to get a license for their dog in their city. So federal, state, city taxes, but the list was like 40 items long, 40 different ways that we pay taxes. So we consider a tax on our gasoline that most of us use, groceries certainly all of us use, and it was suggested that a tax rate of, at that point, somebody was suggesting 30-40% of our money sometimes goes towards taxes.
right. So let's use a nice 30%.
Okay.
So the red, that's the amount we paid in taxes over those 30 years.
Okay.
The faded red, those are the gains that we lost because we're paying taxes this whole time.
Yep. Never earned that
We
671,000.
never earned the
then.
671,000.
Okay.
So now let's talk for a minute about debt service. Matt always talks about, to me, the fact that we finance everything we buy. Sometimes we pay cash for things, often, and that's one way of financing it, or
100% down, right?
100% down. Or you put 10% down and then you're paying it off over 60 months or whatever. And anymore, it seems like you can finance anything. You can finance a cell phone even. You can finance, most people are financing their car, their house, their cell phone, any major piece of equipment, furniture, just about anything can be financed.
Yep.
So And every time you refinance, essentially, because of the way amortization works, and I don't want to get into that too far, but your interest rate is always higher than what the interest rate you're actually paying.
The volume of interest.
The volume of interest, right.
The rate goes down, but the percentage of our payment that goes towards interest versus what goes towards principal, that changes.
Right. And we keep, the average person refinances every 6 years. That just means that
Meaning their homes, right?
every 6 years they refinance their homes and they start over on the amortization scale.
Yep.
So
You know,
they're
we
paying
should
a
talk
large
about that in the
chunk
future.
to interest. So how much, what kind of percentage would you say for debt service?
Well, 20 years ago when Nelson wrote his book, his first book, Becoming Your Own Banker, he calculated it out fairly accurately at 34.5%. And even though Dave Ramsey has done a lot to help people get out of debt and stop paying that 34.5% in interest, and a lot of other people are working to get out of there, there's still a huge amount of people who are out there paying interest. And no matter what side you're on, as Darren was saying, you're either giving up the interest that your cash could have earned if you pay cash for something and you don't finance. You're just financing it yourself and giving up that 4% that it might have earned somewhere else. Or you're borrowing money and paying that to somebody else. There's really not that big of a difference between those two options, mathematically. So if we continue with the trend, and what I see out there also is 30 to 40% as well. For a long time, people have been paying roughly 30 to 60% of their income in taxes and financing their lifestyle. It's part of the American dream. You can buy anything if you can afford the payment, right? And if some people are arguing that point, all we have to do is look at loan terms for vehicles and specifically, but also homes. People are stretching those loan rates out. We've seen car loans that are now 9-year loans, and you go back 20 years, that was absolutely unheard of. Even a 72-month loan on an automobile was unheard of. But the financing institutions need to stretch those time periods out. And so we know that this is in reality happening. And then to your point, if a person is refinancing their home, literally 80% of the payment they are making on their home is going towards interest. So please understand, when I say that a person's after-tax dollars, 30% of those after-tax dollars are going to finance charges, I'm referring to all of those things. And it's pretty close to 30% still.
Okay, well, let's use 30%. So, obviously that dramatically changed things. So this blue section here, that's the amount of debt service that we paid. It's the same number as our other, because
The
they're both
taxes
at 30%. And once again, we lost another $671,000 that we never earned because that money was paid out.
So we have the one shade of red reflecting what's lost because of taxes, the
Correct.
other shade of blue reflecting what we lost because we financed so many things in our lives, and that money never had the potential to earn. So let me make sure I get this straight. You're saying that if I finance things and pay that money out, that money's never earning $671,000 for me, right?
That's correct.
And I say this to everybody who tells me they don't finance anything. They pay cash for everything. The truth of it is, they are losing out on quite a bit of money. If they're paying cash for a used car every 5 years, $10,000, $20,000 for a used car, they're saving money for sure by not financing it through the financial institution. They are losing money because that $10,000, $20,000 every 5 years is not earning 4%, 5%, 6% someplace else for them, right?
Right.
Ouch.
And so overall, let's take a brief look at this. Now you've put in $1,141,000 and you're getting out $895,000. So less than half of your money is being saved. And this is getting more and more realistic for the average American.
Sure. So the potential was over 5 million.
Correct.
The end result is less than $1 million in under their mattress, shoebox, bank, CD, whatever it is.
Right.
Well, some place where they can earn
Well,
4%, not the mattress then.
And that's just in interest. So the
Yeah.
total savings with interest it still adds up to $2 million. But now let's talk about
Oh, gotcha.
lifestyle.
Okay.
So 60% of our money is going to taxes and debt service.
Yep.
How much of it goes towards the rest of our lives? We've got, we all eat.
Mm-hmm.
We use
Some
gasoline.
of us more than others.
Right? Gasoline, kids' soccer games, school supplies. There's a litany of items that we spend money on. Now we've got, any given household. I think my household's got what? 2-3 subscription-based services. You've got different kinds of insurance that, you've got to insure your automobile, you've got to insure your house.
Mm-hmm.
So how much of that goes away because of the lifestyle you live? And this changes for everybody. Some people are really, really frugal, and some people, their lifestyle exceeds the 100% in their financing
Yeah.
day-to-day expenses.
Yeah. What we see, the trend of how much a person saves, I can comment more on that, and maybe we can do some backwards math, but
Okay.
the savings rate in America is not very high. During the pandemic, people saved more. When people tend to worry about things, they save more. So if we were being quite generous, I think we could put an average savings rate in of 5% and cut that out. So how much money is left to
So
pay for lifestyle?
that leaves 35% to pay for
Okay.
lifestyle.
Okay.
And I really get prepared for this because it doesn't leave much. So yellow is lifestyle. We paid roughly $1 million over the course of our lives to take care of ourselves and our kids and all the important things we've got to do. And I'm not telling anybody that just because to not live. Life is more important than money, but life costs money.
It does.
And we all have to be aware of that. And life, of course, because it costs money, it means that those opportunities to invest that money are also gone. So almost 40% of the $5 million is lost just because we never earned the money in the first place.
Yep. Let's say that a person was dedicated, and a lot of you are, and let's say they were saving 10% of their money. That would be, based on that income, that would be $6,000 a year. What I was thinking, on the previous spreadsheet that we were showing 5,000 plus an employer match, right? Something like that. So if these people are dedicated, I know that a lot of you are, a lot of us are trying to do more than the average. This shows an average of 5% being saved. And honestly, a lot of us are going to be more dedicated than that. We're going to do 10% or even more, right? But if we do 10% here, then it more closely resembles the other calculation as well. So let's scale lifestyle back to 30, which means 10% of the income is being saved. And I think that will more closely reflect what disciplined, dedicated people are going to be doing.
Right.
So now, walk us through those results.
So everything else is 30%. 30% of your lifestyle is going to, or 30% is going to your lifestyle. It's $856,000 over those 30 years. $856,000 is going to the debt the service on the debt that you have. $856,000 goes to taxes, and you've got $671,000 for each category that you aren't earning because of the lost opportunity over those 30 years. And so the net result is that you've got $285,000 you saved, and at 4%, you've got $223,000
Okay.
left over.
So almost $500,000 in some kind of a long-term reserve fund, whether we call it retirement plan or whatever that is, long-term reserve fund that earned 4% over the period. As
Right.
safe, obviously not a market return or something, although that previous calculation showed us that after fees and whatnot, we're not really earning 8% in an 8% fund. But
Well, but let's talk about that for a minute. This is why people feel driven or feel like they have to enter the markets. They have to have some risk. They have to invest in a qualified plan, is because a 4% CD ain't going to cut it. You've got
Yep.
$500,000 right here.
Yep.
And you've got to live off that
Mm-hmm.
for 30 years. So let's take this and scale it up
And part of the reason, I agree, no, go ahead and do that.
to 8%.
What we're looking at here, we can discuss the accuracy of 30%, 30%, 30% all day long. And we can do things like this and scale from 4 to 8%. When people talk about their financial portfolio, average American out there talking about his financial portfolio, he's ignoring the taxes, the debt service, the lifestyle a little bit, unless you listen to somebody who's talking about rice and beans, beans and rice, in order to scale back the lifestyle and be able to save more, pay off some debt, then that certainly works. But scaling back the lifestyle isn't anybody's long-term plan, right? Most of us want to get to a point where we have enough to spend and have the lifestyle that we've always wanted. So most people are in a picture similar to this: taxes, debt service, lifestyle. And rather than thinking about changing how much is going to taxes, debt service, and lifestyle, most people ask their advisor or their friend or whoever seems to be doing something to earn money. They ask, what can I do to earn more, right? So we go from 4 to 8%. And the difference, what difference did that make?
So, under 4%, we ended up with about $500,000. With 8%, we've got almost $1 million.
Okay.
So you double your money.
Well, the contribution's the same. It only changed what's the difference in the growth?
The difference in the growth is, well, come on now, I'm looking at the wrong numbers. Okay, 4% is $223,000, 8% is $700,000. So the growth is actually multiplied by closer to 3. You're taking $223,000, now it's $700,000.
Okay. So a difference of
A difference of about
480?
$480, almost $500,000.
Okay. So a person earns almost $500,000 more. Okay. Now the alternative to that, and this is where what I do plays such a crucial role in what I teach. I teach people to scale back what they pay in taxes and especially what they're paying in debt service. So we can, if a person can get a 100% increase on their savings rate, going from 4 to 8%, they'll receive an extra $500,000.
Right.
Normally, as you were saying, that includes taking on more risk. And the definition of risk, from an actuarial standpoint, how do you define risk?
Risk is basically there's a chance that instead of earning 8%, you're going to lose money. Or risk by definition is there's a probability of failure.
So we take on a greater probability for failure, risking our money in order to get that potential return. And we're putting in 8%, and we know 8% a year is extremely unlikely. Not impossible, but extremely unlikely for the average American. But let's say that happens, we earn an extra $500,000. The other option is to scale back our lifestyle, especially scale back our debt service, and scale back how much we're paying in taxes, right?
Right.
So let's chew that down just a little bit and see what that new total is if we chew those down.
Well,
Let's say, go ahead.
Oh,
Go.
I was just going to say, let's not decrease the lifestyle, because there's 100 different financial planners, advisors who will tell you to scale back that lifestyle. And frankly, if you're listening to this, you've probably already scaled back your
point.
lifestyle. And it's hard to scale back beyond a certain point. I mean,
Sure.
rice and beans only taste so good. There's only so many ways to do it. I mean,
Sure.
and
it's not a long-term plan anyway.
it's not a long-term plan.
Some of us will do that for 2 years, or maybe we have to do it for 5 years to get to a certain point. But then at that point, we're buying steaks, right?
Right. Some of us are planning on going to college or sending our kids to college someday.
sure.
And
Yep.
you can't do that on rice and beans.
Yep. Very good.
So, but instead of trying to do it on rice and beans, what if we scale back the taxes?
Sure.
What if we can show you a way to, instead of paying 30% in taxes, let's say we can only take it down by, what would you say, 5%?
Yeah. Taxes are so, a lot of it's out of our control. A lot of my clients own businesses, or home-based business or a brick and mortar business, and it's a lot easier for them to change that tax picture.
Right.
But for the normal person who's out there just working a job, we can do some things, but you're right, 5%. So what does that do by scaling that back?
By scaling that back, it increases the amount you actually put aside in savings, for starters. So now instead of putting aside $200,000, now you're setting aside $428,000.
Okay.
And you get a return of $335,000 at 4%.
Okay, so we scale taxes back at 5%, and rough math, it looks like we're just about the same as we were moving our earnings rate from 4 to 8,
Not quite, but close.
just by scaling back taxes at 5%. So starting a business or having an opportunity to deduct more in taxes, not that much more, gives us almost as much as doubling and taking on that much more risk and trying to double that rate of return.
Right.
Okay.
Well, and especially what we're talking about is taking somebody's, so we're talking about reducing their tax load, but we're also talking about changing the way you finance your life.
Mm-hmm.
And if you're not financing it through debt service, if you're not paying interest to some entity, if you're not paying closing costs to some entity for everything you own, and obviously you're probably still going to have a mortgage and you're still going to have some of these other things. But if we can scale this back, do you want to say another 5%? Or 10%?
You've read the book, and I've read the book, and you've ran the numbers, and I've ran the numbers. Over a person's lifetime.
Well, they can scale back a lot more than 5%, but even at 5%,
Go ahead and add another 5.
at 5%, they've, without taking on additional risk, they've got the same amount, actually a little bit more in their savings with interest than putting their money in a market fund somewhere.
So their money, see, there's places, especially over a long time period, there are places where a person can put their money and get a guaranteed 4% no market risk. And I like using that number because it is reasonable. You can find places all over where over 30 years, it's been proven over the last 30 years, it's likely to happen in the next 30 years, and leave that alone. There's no loss of your money, no potential for loss. Guaranteed not to lose that. Debt service. It's so easy to scale that back 5% if a person is dedicated, willing to live on rice and beans for a little while maybe in order to get some debt paid off, or if you're young enough that you are able to do this before you take on the debt and you're able to start with 25 instead of scaling back from 30 to 25, then hallelujah. But if you're old enough and you've taken on all of this debt, visit with us. Let us see how we can scale that back for you. But hopefully a lot of you are able to learn from this that you just don't want to get into debt in the first place. And realistically, for folks who understand this, 25% is still way too much. I mean, if a person is really trying to become their own banker and take control of the financial aspect of their lives, that financial function in their lives, they're paying for vacations, which we just learned on the break when the train came by, that a vacation is where you go in the wintertime when it's cold in Idaho so you can swim in the ocean, right?
Yeah.
Everywhere else is just visiting, taking a trip, but not a vacation. So, if we finance those vacations, $3,000, $5,000, $10,000 vacations, we are financing the purchase of our cars ourselves. We probably still have a mortgage at a bank. That's an awfully large purchase. But all the rest of that, there's no reason to put TVs, furniture, cars, and other things on credit. I want you to cut that in half, go from 30 down to 15, and see what difference that makes.
So now, let me pull this aside here, if I can. Oh, okay. Well, you've got $856,000 you set aside, $671,000 that you've earned at 4% interest, and now you've got $1.5 million, which is a whole lot better than living on rice and beans.
Absolutely. We didn't touch the lifestyle at all. We did not ask anybody to go and take on more risk. Just stop financing your life using somebody else's money. If we control the financial function in our lives, we literally are capturing $1 million. Oh, by the way, depending on where that million sits, it's someplace that isn't subject to taxes down the road. So that when it says 1.52 million, it literally is 1.52 million.
Well, and that's why we reduced the tax load, is because when we talk about what you and I are doing, we're not placing it somewhere that's subject to taxes down the road. That's why you can safely say that it's tax-free in a way that's entirely legal and moral and ethical.
Yep. Some of that's tax deferred, some of it is tax-free.
Right.
If we use it correctly, then that portion that is tax deferred, we can have access to it without paying taxes. So yeah, we literally can use that without tax consequence. And when we look at those slices of the pie, this is what excites me. There's a slice of that pie that is going someplace it doesn't need to go. A big slice of that pie going someplace it doesn't need to go. Remind us what color that is. That's the blue?
The blue.
And if look at how much, there's still $335,000 we aren't earning because we're still giving up some financing
To somebody else.
And some of you are going to be able to scale that back even more. And maybe you get to a point where the only interest you're paying is the interest on your mortgage. And in fact, if we just jump, let's remember the number 1.5, move the 15% down to 10% and see what that extra 5% does. Okay.
It's 1.7
Okay.
now.
It's worth working towards. Tax-free money for the future. And this is how we help you keep more of the money you're already earning. So many people, unnecessarily, unknowingly, they are transferring money out of their pie, transferring a big piece of that pie to somebody else's pie. And they don't need any more of the pie. You look at, bankers throughout history are always pictured as fat and happy. They get plenty of pie. That's the truth. So if you want to learn more about how to transfer some of that back into your pie and keep some of that for yourself, send us a message. Ask us any questions about this. We'll plug numbers in. We'll take some time on a podcast and answer the questions and the concerns that you've got. And that's kind of where we're at. The numbers kind of speak for themselves, right? Do you have anything else to say about this?
Not really. The numbers speak for themselves. There's a tremendous opportunity there. And the thing is that it's not necessarily a bad thing to get 8%, but
Of course.
if you can do both, then
Absolutely.
do both. But this way, no matter what, no matter how safely and securely you store your money, or no matter how much risk you take on, you've got a much better chance, and the numbers are actually on your side.
Yeah. Let's address something that a lot of you are going to find interesting, though. If you own businesses, if you're involved in real estate, or you just have a really good, solid understanding of some investment economy, you're in your wheelhouse, you know you can earn 6% someplace. A lot of you are in that position. Maybe you know you can earn 8% quite often. Just for grins and giggles, let's change the 4 to a 6. If you're keeping your debt service low, keeping the taxes low, and finding some place to earn more interest over this 30-year time period.
So, obviously you're still losing money due to things outside of your control, but the end result is $2.4 million, and only $1 million of that is money that you set aside yourself.
Yep. Okay. Well, that to me is realistic. The business owners I work with, this is realistic, better than this is realistic, and quite a few of them are contributing more than the $6,000 contribution that's being made here. So it just gets better and better and better. And over time, the more we've recaptured, the more we have to finance other things in our lives allows us to recapture more and more and more. So over a 15-year period, we've reduced our taxes by more than this. We've stopped financing as much as this shows, and it's even better over time. And then also we're finding opportunities. We have capital to work with. That money that's in green is money that we control. We don't have to petition Congress to change legislation. We don't have to ask our employer if there's some way for me to get a hold of some of that. We control that money. That's the important part. So when an opportunity comes along for us to earn 12 or 15%, we take advantage of those opportunities as well. We're able to move quickly to take advantage of those opportunities. I just know that for most of my clients, it's not something that happens all the time. For those who own businesses, though, it almost is an annual thing. Their businesses need capital to operate, and they're buying equipment, whether it's medical equipment, construction equipment, or supplies. They're buying something. And so then earning 12% on some of that money that's in green is not unheard of by any means. On average, though, it might be 6 or 8% that they're earning. So if you find yourself in that position, you want to learn more about how to do this, you're the kind of people we want to talk to. That's all I've got to say. Thank you very much for showing us this, for building this and putting it together.
Yeah.
And until next time, send us your questions. Let us know what we can help you with. Thanks.